You're viewing the Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for November 1st, 2015. Market breadth. With this past week's market fractional advance, our bull-bear point and figure ratio at 0.85 fell from 0.98 last week, remaining in bearish territory. The total count of securities in bullish or bearish patterns rose fractionally to 2,845. The count of bearish stocks increased 8%, while the count of stocks in bullish patterns decreased 7%. The Pirls PNF Market Breadth Summary Chart shows us a market now 22 consecutive weeks in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the stock market commentary via email, free of charge, simply enter your email address in the provided space. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 30 points for the 7th advance in 9 weeks. At a negative 129.81 points, it continues below all 8 tops above plus 100 and continues above all 5 bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in distribution mode with average daily volume higher than the prior week. In the last 2 weeks, the Nasdaq had 3 accumulation days and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in accumulation mode on higher average daily volume. Momentum. After last week's successful zero-line reject long trade simulation, the CCI 20 daily continues outside the plus or minus 50 range, prohibiting another valid zero-line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's downtrend 6 weeks ago, while the daily CCI 20 began a Woody's uptrend 2 weeks ago. The CCI 20 weekly, now with 2 consecutive weeks above zero, has risen to plus 56.18 from plus 20.03 last week, and is now outside the plus or minus 50 range required for a valid zero-line reject short entry signal, should the CCI 20 weekly fall next week. Industry rotation the last 2 weeks. All of the top industries are positive, and all of the bottom 5 are negative. Bullish comp tech continues in the top 5. Networkers has entered and leads the top 5. Gold and silver has left the top 5 and entered the bottom 5. Bearish REITs has entered the bottom 5. Semis has left the top 5. Focus this week from www.valuewalk.com. Sprott Asset Management on Gold by Trey Reik, Senior Portfolio Manager of Sprott Asset Management. The following are some key points from the article. Most investors hold opinions of gold's merits usually with surprising conviction. Some view gold as an inflation hedge, others as a deflation hedge. During times of financial stress, some view gold as an asset to own, while others might view gold as an asset to short, because of gold's historically inverse relation with the safe harbor US dollar. Many view gold as the ultimate risk-off asset, and just as many view gold as the ultimate risk-on trade. We prefer to focus on the irretrievable gap between financial assets, claims on future output, and productive output, GDP. In essence, the most compelling reason to own gold is that financial assets have lost their underpinnings to sustainable productive output. We believe the dollar standard system is at the heart of mounting global monetary stress. We believe U.S. paper claims, aggregate valuations of stocks and bonds, have become completely untethered from underlying productive output. The outlook for gold rests squarely on the mathematics that U.S. GDP can no longer service U.S. credit market debt without fresh credit creation on the order of nearly $2.0 trillion on an annual basis. We believe quantitative easing programs reflect the Fed's tacit and comparatively recent admission that a credit creation backstop must be provided to forestall U.S. debt defaults whenever the U.S. economy's capacity for fresh credit creation stands at low ebb. Gold's wealth protection relevance will not diminish until the ratio of debt to GDP reverts to a sustainable, functioning level, which history suggests will certainly be no greater than 200%. We have developed 3 litmus tests for gold's portfolio diversifying relevance, which we believe every global investor should currently be mulling. First, could the U.S. financial system endure even moderate normalization of interest rate structures? Second, has the process of debt rationalization been allowed to proceed in U.S. financial markets? Third, is the U.S. economy capable of achieving 3 to 4% GDP growth with a healthy net national savings rate of, say, 8 to 10%, alleviating the need for copious amounts of U.S. non-financial credit growth? If the answer to all 3 of these questions is not yes, gold remains a mandatory portfolio diversifying asset. Thank you for tuning in for this week's Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, and wishing you true success.